All right, let's move our attentions now to our final section on the docket, and that is obviously the property data story. So we saw Corelogic's February hedonic home value index come out, and we saw a really strong result in Sydney, plus 0.5 of 1% for the month. Brisbane, plus 0.9 of 1%. Adelaide, 1.1. Perth, a clear standout, as we clearly predicted at the start of the year, which is very much an affordability story and investor-driven over there as well. 1.8% up for the month. It's incredible. Hobart continues to decline, negative 0.3. Darwin, an anemic 0.1. Canberra, 0.7, which is also pretty strong. And I missed Melbourne there by design, because Melbourne has definitely been, one of the poorer performers. And you look at the median value in Melbourne is sort of disproportionate to its overall economic position. But that is purely designed based on, some of the state government's decisions that they're making around their housing policy down here. And that's really saying that investors are tapping out of that particular market or not interested in buying into that market. Now, I do want to make an important point here because this is my wheelhouse. I've been through these types of government policy cycles before in different states and territories over the journey, and it does impact sentiment, and it does ultimately impact in terms of buyer activity. That's if you think in the short term. And so ultimately, the next government that comes along will reverse these types of policies, because the story of Melbourne is going to be a chronic shortage of rental accommodation, vacancy rates very low, and continuing very strong rental increases until they work out that they need to bring the tens of billions of dollars back into the economy from the mum and dad small business private rental accommodation provider. So that is going to be the story of Melbourne. So if you want to buy counter-cyclical in Melbourne and take a decade's view over the course of the next 12 to 18 months, you're probably going to be looking at that. But bear in mind that you're going to pay short-term higher land tax costs. So obviously that's a tenant tax, as we refer to it, because it will be passed on to the tenant when conditions are at that sort of imbalance between demand and supply. There was also a couple of graphs that I wanted to point out. At the start of the update, we wanted to highlight the change in the quarterly value. And this comes back to Bryce and my predictions episode on the Property Couch podcast a couple of weeks back, where we were talking about it's very clear to us when you look at the quartiles. So you can see here on this graph, and for those listening along, the lower quartile and the middle quartile. So the middle quartile represents from 25 to 75, and then the lower quartile is the bottom 25% of values, and then the upper quartile is the top 25 from 75 to 100% of the values. Now, historically, this is the ripple effect. This is the power of the big, city centres driving that economic growth, and we always see that the upper quartile usually leads the change in values, and then that trickles down into those other markets. But again, you see examples of where there's manipulation in the marketplace, such as APRA with their 3% buffer rate, which is still in place, which is reducing borrowing power. So it was a pretty easy prediction that Bryce and I made about which are going to be the best performing markets. And those markets are going to ultimately be the lower and middle quartiles as opposed to the upper quartile. So let's look at the final chart here where we see these breakdowns, and we can see in terms of the Sydney quartile, it's very clear that the bottom end of the market and the middle end of the market is outperforming the top end. In terms of Melbourne, where you're seeing contractions in property prices over a 3-month rolling till February, you can see that the biggest value that's being given up is at the higher quartile. Brisbane can clearly see that the cheapest price points of the market's outperforming everywhere else. Adelaide, same story. Perth, same story. Hobart, again, you can see how that contraction's working from highest values falling further than the lower values. And then Darwin, you're also seeing, some of the lower price points doing quite well because the yield story in Darwin is a ripper. And then you've got the ACT, where the middle market is actually doing most of the heavy lifting. But you can also see the lower quartile, the cheapest property prices growing, but the upper quartile also stagnant as well. So you can, that was the message that I want to put out there for the property market for this update. We'll be obviously doing another one in about 6 weeks' time. So we'll do some more deep diving into vacancy rates and what's happening with yields and rents and that type of thing as well. But that just gives you some clue in terms of what's actually happening out there. So finishing up for me, before I hand over for a final word from Evan, it's really clear that there is the data is going to inform where we sit. Sentiment does seem to be okay in the Australian market. So we're going to see what that correlates in terms of the consumer. We know the government's going to spend because it gives them votes. And we obviously know the business conditions are still okay, but easing. So it'd be interesting to see where that goes. What's your final take as we wrap up, Evan?
So my final take, we've been sort of alluded to it through the entire talk, is about also the impact of interest rates on the whole economy. And why I'm finishing on this point, Ben's just highlighted perfectly what's going on in the property market and where it's at. There was data that came out in the last 6 weeks that showed that 1 in 4 house purchases last year was in physical cash only. Now, that should be the case because what we know, the majority of it is people that are downsizing or people that are now moving out in empty nest scenarios. So that's a good thing to see, actually. I think that's a positive. But it also shows that 1/3 of people don't have a mortgage. And if you think that 1/3 of the entire housing population also rents, it shows you that already 66% of the population is somehow not touched by interest rate movements. And that is the other part of this equation. And it's a conundrum to leave you on. I think it's a good one, is that realistically, 1/3 of the population is feeling the pressure. We know that. It's not a new comment. But what it also asks the question about is whether or not monetary policy is the only thing that we need to be using right now to try and slow things down. Because if we do, and as it's showing, sticky inflation's coming, there has to possibly be other options to try and get it down rather than a sledgehammer that is interest rates to move it. So that will be the debate going forward this year, is that there are a small parts of the population wearing it than what was in the past. And there are actually parts of the populations that are benefiting more than usual because of their current situation in the economic cycle.
So are you trying to tell me that, Evan, that governments will look at fiscal policy when they're running a big super?
What I'm saying is that the thing that governments need to start looking at is, and we've started to hear it over the last 16 months, is tax policy. Now, again, governments hate tax policy because it doesn't buy votes, as you highlighted quite well, but it needs to be started to be discussed. That taxation, particularly for those that are over 55, needs to start to be reviewed. Why I say them? They are the ones moving into superannuation. They are moving into tax-free environments. More and more spending on things like health and that kind of space is done through government spending. And therefore, do you have to start asking the population to start, fixing up that with
paying their own way?
So that's the question. And I get into a lot of trouble with it, but I'm okay with it. It has to be raised. That discussion has to be there. Because if the older generation is getting an interest rate rise to their term deposit or cash rate return, plus they don't have an interest rate on their mortgage because they don't have one, and they own, as you highlighted, a wealth effect that is just growing anyway, they are sitting pretty. And any more interest rate rises helps them because they can spend more because they've got more in their back pocket. So that is the conundrum that I'm leaving you with, is that how do we address that problem going forward? That will be the next question. And it's the big question, big, hairy, audacious question that all governments, all central banks are going to have to ask over the next 5 years. How are they going to deal with the skewed demographics that are now coming out in economics?
100%. And I've been saying really on record for over a decade now that if you think that tax policy, superannuation policy, death taxes and all of that will stay stagnant where they are, and governments have a fetish for spending, right? And now the community is getting, since the GFC, this whole stimulus and everything now, and then COVID, we now expect our governments to buy our way out of all of our problems. And if we continue to expect that, then ultimately we're only on a road to higher taxes, in terms of that story. And
higher spending will bring higher taxes.
It will. And so that is the story that we're on. So, which reminds our great community that we still got to strive to be self-reliant.
Yes.
I mean, as much as you don't want to be reliant on government to basically fund all of your retirement. You don't want to be on pensions. You want to be able to build up a bit of a nest egg and get the power of compound on your side. But bearing in mind, you will pay. I have no doubt that this transition of generational wealth, this $3 trillion that's going to roll down, the government aren't not going to look at trying to take some of that away from you. And then ultimately, as you build family wealth and legacy and generational wealth, they will continue to keep shaving away at that to try and provide for those most need in our community. The big the $64 million question for me has always been just how much welfare is enough welfare. You keep giving too much welfare away, and you're not stimulating those people to actually try and get into the workforce and try and build up their own wealth. But certainly we need to make sure that the most vulnerable in our community are protected. But that's the great debate of politics in central politics versus far right, far left. And I think that's a wonderful way to keep people guessing in terms of where we're going to go. But just make no mistake, they are going to come after taxes at some point, because they will continue to try and take more of our money, that's why I'm a big believer in smaller governments and less spending. But that's not going to be what happens in our country. So until next week, always remember, knowledge is empowering, but only if you act on it. The next RBA meeting will be on the 7th of May, so that's when you'll hear from Evan and I next. So until then, take care and bye for now.